Guys, the stock market usually rises when the Fed cuts interest rates. Why was today different, and why was the sell-off so severe? Also, why are long-term bond rates a lot higher now than when the Fed started cutting rates in September? Let's start with the Zero Hedge article showing what many people suspect, that the half-point rate cut in September was nothing more than a boost to keep the stock market up to help Kamala Harris win. So here Zero Hedge says, markets plunge as post-election Powell unexpectedly turns ultra-hawkish all of a sudden. As a reminder, less than 3 months ago, the Fed slashed rates by 50 basis points. That's crisis-style cuts. So the red line is the Trump over Kamala odds. The green line is the Fed funds rate expectation for December 2025. So while Kamala was gaining ground on Trump, the rate expectations stayed up. But once she lost momentum, then the Fed signaled that they were going to slash rates and by a lot. You see that it went down as low as 2.8 percentage points expectation for 2025. Meaning from September 2024 to December 2025, they were going to slash rates by over, 2.5 percentage points, something like that. And this is when the half a percentage point rate cut happened. But that didn't help, and Trump gained ground and won. And now the Fed's expectations have shifted to being more hawkish, to the point where December 2025 rate expectations are about 4%, or only about 25 basis points lower than where they are now after today's cut. In other words, in September, the Fed was signaling, we're going to give you 2.5 percentage points in rate cuts going all the way out to December 2025. And now they're saying, going out to December 2025, you'll be lucky if you get a 1/4 point rate cut now. So if they did cut rates to help Kamala, the election is over. Why did they still cut rates today? Well, it is definitely not because inflation has been beaten. Maybe it has to do with the $7 trillion in new debt funding they will have to issue in 2025. They want to have lower interest rates when they are issuing all that debt in 2025. Or maybe they see a recession coming. So this is the $6.7 trillion in debt that they're going to have to roll over in 2025. So yes, they would like lower interest rates when they do this. However, they're kind of walking a tightrope here because they can only lower rates so much before inflation comes back. And as you see here, the red and the green line, U.S. Bloomberg economics inflation data surprise and economic surprise hard data. And as you see, when the rate cuts began, we've had nothing but increases in these economic inflation data surprises. So inflation is ticking back up by most measures, and yet they're still cutting rates. And Powell says, we look at all financial conditions when they lower or increase rates, but apparently they didn't do that very well until now that Trump is back. So what they're saying is the Bloomberg Financial Conditions Index was very low over here in 2021 before they started their raising rates to over 5%. Well, we are now at these same type of very low financial conditions index, and yet they're cutting rates here when they were raising rates here. So the reason stocks sold off is because they changed their stance on how many rate cuts they will have in 2025 to now just the Fed is going to assess the data regarding the extent and timing of future moves, kind of BS. So here are the 2024 expected Fed rate cuts in green and 2025 in red. So you see this last 1/4 point Fed rate cut was completely expected here, but only as far back as maybe December 7th or so, they were expecting about 0.7 of a percentage point or maybe 3 cuts in 2025, this red line. Well, now, as of the 17th, it's basically down to 0 or maybe 0.1 percentage point going out the whole 2025. So all this promised 3/4 of a point cut is now up in smoke in all of just 1 week. And that's why the market is really jittery, because there's no more sugar high that they promised. They're taking away the punch bowl, so to speak. So why are they now backing off on further rate cuts? Well, inflation is still coming back, and the bond market sees this and is responding by yields going higher with the expectation that inflation is coming back and rates may have to be raised in the future, like happened in the late 70s when they started cutting rates too soon and inflation came roaring back, and Paul Volcker had to raise the Fed funds rate to over 20% to break the back of inflation. So looking at bond rates, when they did the first half a point cut in September, the 10-year was about 3.6% and the 30-year was under 4%. So now after 0.75 percentage point lowering of rates, the 30-year bond is 4.65% and the 10-year note is like 4.5%. What's going on here? So some people think we may be doing a repeat of what happened in the late 70s, early 80s. The red line is the inflation rate and the blue line is the federal funds rate. And you see, as inflation was going up, the Fed raised interest rates, but then lowered it all the way down to 9% prematurely, and had to turn around and go back up to about 20% to finally crush inflation. So they did it prematurely, lowering rates, and then had to turn around and really rush to really overcompensate to crush inflation. But even though the market was down a lot today, it's pretty much at all-time highs, right? So it can't be that bad. Well, let's see how bad the market is taking this news and how it compares to some historical stats about the health of the stock market. So just looking at this chart of the futures of the S&P 500, the NASDAQ, the Dow, and the Russell 2000, you see they're down anywhere from 2.7% to the Russell, which was down about 5% at its lows and closed about down 4.5%. Now, if you notice that the Dow was trending down for a number of consecutive days, it actually made a record, the most consecutive down days going all the way back to about 1976. And the number of consecutive negative breath days mean decliners outpace advancers. There were 13 consecutive days of this, which blows away the previous records of like 8 consecutive days. And that goes all the way back to October 1996. So looking at Goldman Sachs's index of the most shorted stocks, these are probably a lot of companies that have little or no earnings. They took a big hit because this is saying goodbye to the promised cheap money for the next year. And even Goldman Sachs's mega cap tech index has also taken a big hit. So the Mag 7 were holding up the market. Now they are falling just like everything else. So what do you think? Was this cut a mistake? Was it done because they see a recession coming or because they want lower funding costs for 2025? And will this stoke inflation more to the point where we get into a Paul Volcker situation where inflation comes roaring back and they have to reverse the rate cuts? Also, what does this mean for the stock market with a highly elevated valuation and a high market value to GDP, as Warren Buffett likes to watch? Is this the internet bubble all over again, but with AI? Let me know what you think. Thanks for watching, guys.